Most of the companies that are valued more than 100 billion there right now are 20 years or older. And so if the growth is not occurring there, does it make sense to weight investments there just because the PEs or the PEs are lower, the stocks appear to be cheap?
Well, I think you need to differentiate between buying the beta and investing to try to generate alpha. When it comes to the rest of the world, I think that the clouds are breaking. There are a number of things that we see that make us more constructive on the outlook for international stocks going forward. Obviously, valuation, which has been in play for quite some time, dividend yields are higher, expected earnings growth is more robust. We do think over the long run, the dollar is too expensive and needs to weaken. But this isn't me saying you should go hugely overweight international. It's more so that we look at a lot of different portfolios, and a lot of the client portfolios we see are actually underweight international. And so this is more about closing that underweight and bringing the two back into more balance rather than it is about initiating, a significant overweight in that asset class. But again, you think about what happened to Europe in the aftermath of '08, double dip recession, fiscal austerity, right? China was kind of doing its best to keep the world economy going, and obviously they're dealing with some issues there. So it's not like the shirt is completely clean, but I do think that the outlook for places like Europe and Japan and EMX China has very much improved relative to what we saw over the course of the past 15 years.
Good. You guys got anything on that?
Well, I mean, part of the excitement around the U.S. too, though, has just been we've been the concentrator of growth. I mean, we've created $6 or $7 trillion companies, and I'd have to check my numbers here, but I don't believe in Europe they've created $100 billion company in the last 20 years. Most of the companies that are valued more than 100 billion there right now are 20 years or older. And so if the growth is not occurring there, does it make sense to weight investments there just because the PEs or the PEs are lower, the stocks appear to be cheap?
Well, I think you need to differentiate between buying the beta and investing to try to generate alpha. Because if you think about some of the companies that are domiciled in Europe, they're very growthy, right? And they'll play a significant role in what's happening and what will happen going forward. I'm thinking about a certain semiconductor company that's based in the Netherlands, right? You think about some of the luxury goods brands. Like I take your point of, okay, so the past 20 years have been kind of tough, and that's because it was all about the banks in the early 2000s, and then the banks completely blew up, which kind of left this like pothole in Europe that they had to figure out how to fill in over the past decade plus. But I do think when you look at some of the companies that are domiciled in Europe, right, they're very global by nature, and they're frankly pretty solid. And so this is less about, hey, Europe's cheap, so you should buy Europe. It's more like, hey, there are some really good companies out there that maybe trade. This is back to my point about being a value investor, right?
Yep.
That may be trading at a discount relative to their intrinsic value, and you don't want to forego those opportunities simply because international hasn't worked in recent times.
What about currency? The dollar's been so strong for a really, really long time, and obviously that's a big factor in U.S. versus international performance when you're comparing the two. You guys see the dollar weakening at some point?
So we think in the short term, the dollar probably continues to strengthen. The U.S. is the best house on the worst block. We have higher rates, we have better growth, and there is uncertainty out there, right, which tends to support the performance of the USD. When we think about the long run, though, it's really all about the country's trade balance or current account balance. And the reality here is that the United States runs a chronic current account deficit. And so, put differently, we are a net borrower of dollars from the rest of the world. And what that means over time is that the dollar should be getting weaker rather than continuing to get stronger. So structurally, right, part of the argument for owning international is that you're going to get more of a currency tailwind than has obviously been the case over the course of the past 10 to 15 years.
Yep, understood. Well, other things going on in the world. Well, we're into another Middle East conflict. Not that we've had one very recently. There always seems to be something going on. Again, not a political judgment. That's not what we're here to do. But we do manage money, and it's about markets. So just some examples of other times of turmoil in the world, how markets reacted.
I actually go ahead, David. I'm sorry.
No, go ahead. Go, please.
I was going to say, I had a slide I wanted to bring up here that talks about that, because we get clients calling in all the time whenever there's some news out there that's, whether it was Russia and Ukraine, whether now it's what's going on with Israel and Hamas. I mean, there's always some sort of conflict going on, or when it does, the calls come in. Okay, well, is this the next World War III? Is the world coming to end? What's this mean for the stock market? What's my account going to do? Do I need to go to cash? Those calls and questions that come in. And so, looking back, we never want to say that wars are good by any means. Sometimes they're necessary, but we're taking kind of the human element out of this, and the fact that there is loss of life, and looking more just from a technical market standpoint and what the impacts have been, historically. And so we remind clients that, news can cause markets to react short term. People panic. There's that knee jerk reaction. Markets sell off. I go back.
I think recency bias too, Kyle.
Yep.
Recency bias as well. I mean, every single time this occurs, it's always like, well, it's never been this bad. It's
Right.
this. Well, this has never happened before. But I mean, that's what we say every single time, because it
This
feels
time's
fresh,
different.
and it's absolutely awful this time. But I'm sure that many of our folks, I mean, if we could go back in a time machine, would have said it about many of the awful wars that have occurred.
Right.
And I think the key thing when it comes to geopolitical conflict is, again, not to minimize the human element of it, but from an investment perspective, you need to think about, what that means for the markets and the economy. And so we always think about the channels by which geopolitical conflict can impact the markets and the economy, and there are basically two, right? It's commodity prices and it's government spending. And so if you're trying to figure out what the impact of the current situation is going to be, watch commodity prices and watch what happens with respect to fiscal policy, particularly around defense. But we try to, and I think that chart did a great job of highlighting that markets tend to get over this stuff relatively quickly unless it breeds a much more significant issue vis-a-vis commodity prices or fiscal expansion.
Yeah, let's bring that chart back up. I kind of wanted to talk it through for those of the people that aren't actually watching, that are just listening to, and kind of essentially what the chart's showing is, the past 10, 11, 12 conflicts, whether it be Pearl Harbor, whether it be the U.S. terrorist attacks, Boston Marathon bombing, even Russia, Ukraine, all the different wars or conflicts or events that have happened, and going back, and essentially we look at those, and there's times where 9/11, we had a 5% one-day drop in the market that hit the heart of New York right there, right? So the whole market exchange panicked, everybody panicked, and then Pearl Harbor was another negative 4%. But historically speaking, looking a little bit further out from these events, the one-year numbers are usually positive, with the exception of the terrorist attacks on 9/11. Max drawdowns, usually stuff we experience throughout the year on a normal year, 10%, 6%, 12%, with Pearl Harbor, it was 20% was kind of the lowest that we hit in that period. And the highlight here is really just how long does it take to essentially reach bottom and then also recover. And so most of the times those bottoms are hit relatively quickly, and we saw not too severe, nothing like we experienced in 08. And then the days of recovery, I mean, in every instance, it's been less than a year that the markets, we're back above where they were prior to. And so that's just, obviously it's history. We can't say that's going to happen every time going forward, but it's something we definitely look to and reason with when clients call in regarding, okay, what about this time?
Well, David, to your point about commodity prices, I mean, late September, crude oil's in the low 90s. We're around 73, $74 today. So that's a lot of that has come off, even though there's conflict over there right now, and that probably just points to, it's pretty localized. If it spreads and gets bigger and bigger, and we have more problems, then that's going to lead to a different outcome, I think.
Yep, I think that's spot on.
Yeah, and like Jason mentioned with recency bias, we were at a conference one time and they were talking about just how you tend to think that this is going to be worse. This is worse than it's ever been. And the truth is, it's actually probably better than it's ever been. One of the things they talked about was danger. That it was very dangerous, and people tend to think that the world is as dangerous as it's ever been. And the truth is, it's actually as safe as it's ever been. There are less people losing their life today in wars and conflicts than ever before in human history. And you go back to, in modern times with World War II and back through the 1900s, but then you go back to, the Genghis Khan era and Napoleon. I mean, large percentages of the world was passing away from conflicts, from disease, from all kinds of things. And again, now we're actually at the safest time in human history. Although, like we've talked about, no war is good, no loss of life is good. But it's not different this time in a negative way. We're actually, like I said, we're actually probably better off than we've ever been.
We're the safest we've ever been, but we're also the most aware we've ever been. And I think
For
that's
sure.
what puts a huge spin on it, is that even though we're the safest we've ever been, it feels the most dangerous just because it's in our eyeballs and we didn't have access to that, 10, 20, 30 years ago. And that's when we actually felt safe. Doors were unlocked, things were like that, when actually it was probably a far scarier time. We just didn't know about it, and now we know about every single car accident on planet Earth. And so it seems worse than it is.
Yeah, and same with the markets, right? You could only read the newspaper and figure out what the market did yesterday, and now you can watch it, 24/7, at least all market hours, and then get the recap afterwards and the pre-cap the next day, and on and on and on. So
Don't forget futures and after hours too.
the future's not, yeah, we got to keep it going.